Home prices have skyrocketed, and when you go to sell, you might owe a massive tax bill you never saw coming. Since property values have jumped so much in recent years, a lot of homeowners are now brushing up against or blowing past the tax gain exclusion limits. And that's where things get confusing fast. That's why in this video, we're taking a deep dive into exactly how federal taxes work when you sell your home or otherwise give up ownership, and how the home sale exclusion really applies in different real life situations. Some of the things we'll cover might apply to you, some won't. But by the end, you'll know how to navigate the big questions that can make or break your tax bill when you sell a house. And just a quick reminder, I'm not giving you tax or legal advice here. I'm simply walking you through the IRS guidelines so you understand what's possible. Your situation is unique, so be sure to talk with your own tax or legal advisor before making decisions. First off, a lot of people want to know about transferring a home to a spouse or ex-spouse and whether the exclusion applies in those cases. So before we jump into the deeper details of how the home gain tax exclusion works, there's one important thing you need to know up front. If you transfer your home or your share of a jointly owned home to your spouse or ex-spouse as part of a divorce settlement, the IRS treats that transfer as neither a gain nor a loss. That means there's nothing to report and no tax hit from the transfer itself. But there's a big exception. If your spouse or ex-spouse is a non-resident alien, the tax-free transfer exception doesn't apply. In that case, the transfer can create a taxable gain or loss, and all the regular home sales tests kick in. All right, before we get to whether you qualify to exclude part of the gain on the sale of your home, let's go over a couple of situations where the home sale exclusion can't be used. These don't apply to most people, but if this does apply to you, the IRS is very firm about it. 1, you got the home through a 1031 like-kind exchange within the last 5 years. If the home came to you through a tax-deferred exchange, or if your basis in your home is based on a previous owner's basis and they received it through a 1031 exchange, the IRS makes you wait. If you sell it within 5 years of that exchange, you won't be able to use the exclusion we are about to go over. 2, you're subject to tax as an expatriate. This is rare, but if you fall into that category, the home sale exclusion doesn't apply. If you qualify, you can exclude up to $250,000 of profit from taxes, or up to $500,000 if you're married and filing jointly. If you don't qualify for the full amount, you might qualify for a partial amount. We'll go more into a partial exclusion later. Here's how to qualify overall, though. You have to pass 2 primary tests, the ownership test and the use test. We'll dig deeper into the 2 tests in just a moment. But before we do, if you sold your home and the buyer is paying you over time, that's called an installment sale. In that case, you still report the sale using the installment method unless you choose not to. But even if the payments come in over multiple years, you can still claim the exclusion on the gain you're allowed to exclude. The installment method only affects how the taxable portion is reported. Let's get into the meat of the exclusion by starting with the date of the sale. The date matters for almost any test tied to the home sale exclusion. If you received Form 1099-S, that's the form that reports real estate sale proceeds, your sale date is easy to find. It's printed right in box 1. If you didn't get a 1099-S, that's okay. In that case, your sale date is whichever came first, the day the title legally transferred or the day the buyer took on the real benefits and burdens of owning the home. Sometimes that second one happens earlier, especially in creative or delayed closing situations. Knowing this date up front helps you apply the IRS guidelines correctly, especially when we talk about the 2 out of 5 year test. One of the biggest requirements for claiming the home sale exclusion is the home has to be your principal residence, your true main home. Your main home can be almost anything you actually live in, a traditional house, a condo, a co-op, a mobile home, even a houseboat. If it's where you genuinely live, it counts. Most people only have one home, so the answer is simple. That's your main home. But if you split your time between 2 places, the IRS wants you to use a facts and circumstances test to figure out which home really qualifies. The biggest factor is where you spend the most time. But the IRS also looks at several clues that point to your real primary residence. The more of these that match, the stronger the case that it's your main home. The address you use for your mail, the address on your voter registration, the address on your federal and state tax returns, and the address on your driver's license or automobile registration. They'll also look at where your life is centered. Things like how close the home is to your job, where you bank, where immediate family members live, and even where you go for church, community groups, or clubs. Think of it like this. The home that's truly the hub of your daily life, that's the one that gets the exclusion. The ownership requirement is pretty straightforward. If you own the home for at least 24 months within the 5 years before you sold it, you've probably met the ownership test. It doesn't have to be one continuous stretch of time. Those months just need to add up to 24 within that 5-year window. And if you're a married couple filing jointly, only one spouse needs to meet the ownership requirement. So even if one of you bought the home before the marriage, as long as that spouse meets the 2 out of 5 test, you're set on the ownership requirement. Then we have the residence requirement. And this is where a lot of people get confused. So let's break it down. To qualify, you must have lived in the home for at least 24 months within the 5 years before you sold it. Those 24 months don't have to be consecutive. They can be scattered throughout the 5-year period, as long as they add up to 730 days of actually living there. Now, here's a key difference from the ownership test. For married couples filing jointly, each spouse must individually meet the 2-year residence requirement to qualify for the full exclusion. So even if one spouse lived there longer, both need their own 24 months to get the full benefit. And just a quick note here, short absences still count as time living in the home, even if you rented the place out while you were gone. Vacations, work trips, temporary moves, those won't break your timeline. On another note, if you lived in the home for at least 12 months within the 5-year window and then moved into a licensed care facility like a nursing home, your time in that facility still counts towards your 2-year residence requirement. This can be a huge help for seniors and their families. You can only use the home sale exclusion once every 2 years. That's it. It resets every 24 months. So if you haven't sold another home in the last 2 years and claim the exclusion on that sale, then you meet the look back test. Even if you did sell another home during that 2-year window, you're still fine as long as you didn't claim an exclusion on that sale. The IRS only limits the exclusion, not the number of homes you sell. Now that we've walked through the tests that determine whether you qualify to exclude part of the gain on the sale of your home, there's one more piece we need to cover: the exceptions. We're going to dig deeper into a few of these in just a moment, but here's the big picture first. If any of the following situations apply to you, the IRS may handle your qualification a little differently. You went through a separation or divorce while you owned the home. Your spouse passed away during the ownership period. The sale included vacant land tied to the home. You sold a remainder interest, basically the right to own the home in the future. Your previous home was destroyed or condemned. You or your spouse were active duty service members while you owned the home. You acquired or gave up the home in a 1031 like-kind exchange. Part of the home, separate from the living area, was used for business or rental, and that portion wasn't used as a living space for at least 2 of the last 5 years, or you or your spouse or former spouse used the entire home as a vacation home or rental at any time after 2008. Let's dig into the vacant land next to your home exception. You can include the sale of vacant land that sits right next to your home as part of the sale of your main home, but only if all of the following conditions are met. 1, you actually owned and used that vacant land as part of your home. Maybe it was part of your yard, a garden, a play area, anything that functioned as part of your residence. 2, you sold the vacant land and the home within 2 years of each other. The order doesn't matter, just the 2-year window. 3, both sales have to meet the eligibility test, or they both have to qualify for partial exclusion. If you check all 3 boxes, the IRS says you must treat those 2 sales as one single transaction for tax purposes. And that means one exclusion, not one for the house and another for the land. One important thing, though, is if you physically move the home off the land, like relocating a mobile home to a new lot, then that old land no longer counts as part of your main home. So if you sell that empty lot after the home has been moved, you cannot treat that sale as part of your home sale. Here's the next exception, and it applies to service members. If you or your spouse are on qualified official extended duty in the uniformed services, the foreign service, or the intelligence community, you're allowed to pause the 5-year test period for up to 10 years. So what counts as qualified official extended duty? It means you're serving for more than 90 days or for an indefinite period, and one of the following is true. Your duty station is at least 50 miles away from your main home, or you're living in government housing under official orders. This suspension lets service members protect their home sale exclusion, even when frequent moves make the normal 5-year test period impossible to meet. Next up is the remainder interest exception. You can exclude part of the gain when you sell a remainder interest in your home, but only if both of these conditions are true. 1, the buyer cannot be a related party. That means you can't sell to a family member, and you also can't sell to a corporation, trust, partnership, or entity that you control or have an interest in. 2, You haven't already sold another interest in the same home and used the exclusion on that sale. If you took the exclusion once before, you can't take it again on the remainder interest. The next exception is for surviving spouses. If you're a surviving spouse and you don't meet the 2-year ownership or residency requirements on your own, you may still qualify. You also may qualify for the higher $500,000 exclusion. To use the full amount, all 4 of these conditions must be true. 1, you sell the home within 2 years of your spouse's passing. 2, you haven't remarried before the sale. 3, neither you nor your late spouse used the exclusion on another home within the previous 2 years. And 4, you meet the 2-year ownership and residency requirements. And yes, you can include your spouse's time toward both, even if you weren't living there with them. The final exception that we will cover is for divorced or separated taxpayers. If you were separated or divorced before selling your home, you can still treat the home as your main residence if both of the following are true. You're a sole or joint owner, and your spouse or former spouse is allowed to live in the home under a divorce or separation agreement and actually uses it as their main home. Now, there's an important ownership requirement here. If the home was transferred to you by your spouse or ex-spouse, whether it was part of a divorce or not, you can count all the years they owned the home as years you owned it. However, you must meet the 2-year residence requirement yourself. On the other hand, if you owned the home before the marriage and kept it after the divorce, and your ex was not given the right to live there under a divorce or separation agreement, then you can count any year that you own the home, whether alone or jointly, toward the ownership requirement. However, you must still meet the residence requirement on your own. Yay! Here's the moment of truth. If you've met the ownership test, the residence test, and the look-back test, and you've accounted for any exceptions, then congratulations. You've officially passed the IRS eligibility test. That means your home sale qualifies for the full capital gain exclusion. But, and this is where most people miss out, even if you don't meet the full eligibility test, you may still qualify for a partial exclusion. A partial exclusion is allowed when the primary reason for selling your home is a change in your job location, a health-related situation, or an unforeseeable event that forced the sale. You qualify for a partial exclusion if your move was driven by a job-related change. That includes situations like you had to start a new job or were transferred to a location that's at least 50 miles farther from your home than your previous workplace. For example, if your old job was 15 miles away and the new one is 65 miles away. You didn't have a previous workplace. Maybe you weren't working at all, and then you started a job that's 50 miles or more from your home. And this doesn't just apply to you. If this happened to your spouse, a co-owner, or anyone who lived in the home as their main residence, it can still qualify you. You can qualify for a partial exclusion if your move was driven by a health-related reason. You're covered if you had to move in order to get medical care, provide medical care, or simply make that care easier, whether the health issue was yours or a family member's. That includes situations like you moved so you or a family member could get diagnosed, treated, or recover from an illness or injury. You moved to give hands-on medical or personal care to a family member dealing with a serious health condition. And family member here includes a wide list: parents, grandparents, children, stepchildren, siblings, in-laws, even aunts, uncles, nieces, and nephews. Or maybe your doctor flat out recommended that you relocate because your current living situation was making your condition worse. And just like the job-related exception, it doesn't have to be your health issue. If the medical need applies to your spouse, a co-owner, or anyone who lived in the home as their main residence, the partial exclusion can still apply. You can also qualify for a partial exclusion if something truly unforeseen happened while you owned and lived in the home, things most people would never plan for. This includes major events like your home was destroyed or condemned, your home suffered a casualty loss from a natural disaster, a man-made disaster, or even an act of terrorism. And it doesn't matter whether the loss is deductible. And it also covers big life changes that can completely shift your ability to stay in a home, like if you, your spouse, or a co-owner, or anyone who lived there passed away, went through a divorce or legal separation, had twins, triplets, or more, became eligible for unemployment, or had a sudden change in employment that made basic living expenses like food, housing, and medical costs hard to afford. And finally, the IRS sometimes issues guidance naming specific unforeseeable events. If your situation matches one of those, that can also qualify you. Now, even if your situation doesn't fit neatly into the standard categories we just covered, don't give up just yet. You might still qualify for a partial exclusion. Here's what the IRS looks for. Think of these like green flags that support your case. The issue that pushed you to sell happened while you owned and lived in the home. You sold the home shortly after that issue came up. You couldn't have reasonably predicted this situation back when you bought the house. The situation caused real financial strain that made it hard to maintain the home. Or the home simply became impractical or unsuitable for you or your family because of what happened. Okay, now I'm putting on my auditor's hat because this next part is exactly what IRS auditors look for when they review a home sale. And trust me, good documentation can make an audit go smoothly. We already covered the proof you need to show that the home is truly your primary residence, but that's only part of the picture. You also need solid records to back up your adjusted basis because your capital gain is based on the difference between your sale price and that adjusted basis. Here's what you absolutely want to keep just in case you are ever audited. Purchase and closing documents. Hang on to your original settlement statement or other closing documents from when you bought the home. This shows what you paid and any closing costs that can be included in your basis. Improvement records. Keep receipts, canceled checks, invoices, anything that proves money went into capital improvements. These are upgrades that add value, like a new roof, room addition, or full HVAC replacement. Routine repairs don't count, but long-term improvements do. Sales documents. That's the paperwork from the sale. Things such as your closing statement and Form 1099-S if you received one. Speaking of a 1099-S, that's the form titled Proceeds from Real Estate Transactions. If you receive one, you must report the sale of your home on your tax return, even if your entire gain is excluded. And another thing, you'll also have to report the sale if any part of your gain is taxable, no exceptions. When reporting a home sale, you'll typically use Schedule D of Form 1040, Capital Gains and Losses, along with Form 8949, Sales and Other Dispositions of Capital Assets. These forms walk you through calculating and reporting your gain, even if it ultimately ends up being excluded. Hey, if you want to dig deeper into related topics, I have a couple of videos on the screen. For a breakdown of 1031 like-kind exchanges, check out the video in the upper left. And if you recently inherited a home and want to understand how the taxes work before you make your next move, you'll find that video in the lower left. I'll see you in the next one.